The confidence game is over, not wobbling, not bending, not showing cracks that can be patched with another press conference and another reassuring smile from the chairman. Over. For years we have sat here on this channel and we have warned you. We have tracked the data. We have followed the central bank purchase reports quarter after quarter. We have watched the LBMA vault drawdowns and the Shanghai premiums and the reserve allocation shifts. And we have said the same thing over and over again. One day the world will stop trusting the dollar. One day the nations that hold trillions in American debt will look at the math, look at the 36 trillion in national debt, look at the 2 trillion in annual interest payments, look at the printing press running at full speed. And they will do what every rational actor in history has done when they realize the paper is burning. They will walk away. We said when that day came, they would not walk toward crypto. They would not walk toward the euro or the yen or any other fiat promise backed by a different committee operating a different printing press in a different capital city. They would walk toward the one asset that has survived every monetary collapse in 5,000 years of recorded human civilization. Gold, physical gold, bars and coins and ingots held in sovereign vaults under armed guard on sovereign soil beyond the reach of any foreign government or any foreign central bank. But up until this month, that was a thesis. It was a mathematical probability backed by history and logic. Sure, but we did not have the definitive proof. We did not have the smoking gun. We did not have the body. Stop waiting. The gun has been fired. The body is on the table. And the murder weapon, the data that proves the dollar's reserve status is being systematically dismantled by the very institutions the system depends on, is sitting in plain sight in official reports that nobody on financial television has the courage or the competence to explain to you honestly. Because explaining it honestly would unravel the entire narrative they have spent their careers constructing. This is the market cipher. And what I am about to walk you through today is the most consequential piece of monetary data released this year. Not an interest rate decision, not an inflation print, not a jobs number. A data point that proves the global financial order is being rewritten in real time while you're being told to look the other way. While you were watching the stock market, while you were checking your 401k balance and scrolling through headlines about AI earnings and quarterly revenue beats, something seismic was happening beneath the surface of the global monetary system. Something that the mainstream media is either too compromised or too captured by its corporate owners to report accurately. Central banks around the world have just completed the most aggressive physical gold accumulation campaign in over 60 years. Not paper gold, not ETF shares, not futures contracts sitting in a brokerage account, not unallocated claims at a bullion bank in London. Physical metal, real bars, cast, assayed, hallmarked, loaded onto cargo planes under military escort and deposited into sovereign vaults in Beijing, in Moscow, in New Delhi, in Ankara, in Warsaw. Vaults that do not answer to Washington. Vaults that cannot be frozen with a phone call on a Sunday afternoon. The numbers just came in, and they are staggering. Over 1,037 tons of physical gold purchased by central banks in a single year. They did it in 2022. They did it again in 2023. And the preliminary data for 2024 shows they are maintaining the exact same extraordinary pace. 1,000 tons per year. Let that number settle into your mind because I need you to understand the scale of what is happening before I show you why it is happening. 1,000 tons is 28% of total global mine production. It is nearly 1/3 of every ounce of gold pulled out of the earth in an entire year being absorbed by a single category of buyer. And that category is not speculative hedge funds chasing momentum. It is not retail investors buying coins on the internet. It is sovereign governments deploying their national reserves with the deliberation and finality of nations preparing for a world that looks fundamentally different from the one we are leaving behind. For context, you have to go back to the 1960s to find central bank gold buying at this level, the 1960s, when the London gold pool was collapsing under the weight of its own contradictions, when the Bretton Woods system was dying, when the entire global monetary architecture was being torn down and rebuilt from the foundation upward. Within a decade of that buying surge, gold went from $35 an ounce to $850. That is not a coincidence. That is a pattern. That is the sound of a monetary regime dying, and the people closest to the controls scrambling to position themselves before the old system gives way to whatever comes next. And the pattern is repeating right now in front of your eyes if you know where to look. Now, you need to understand what a central bank gold purchase actually represents because this is not a trade. This is not portfolio rebalancing. This is not a macro hedge fund chasing alpha for its limited partners. When a sovereign government takes its national reserves, the money that backs its currency, funds its military, and secures the economic future of its entire population, and converts those reserves from U.S. Treasury bonds into physical gold, it is making the most consequential financial statement a nation can make. It is saying with its entire balance sheet, with the full faith and credit of the nation, I no longer trust the paper. I no longer believe that the United States will manage its currency responsibly. I need an asset that exists beyond the reach of American monetary policy and American political decisions. That is not diversification. That is a verdict. So why now? Why this year and last year and the year before that? Why are central banks from every continent suddenly acting with the urgency of a patient fleeing a burning hospital? Is it because gold is shiny and they like the way it looks sitting in their vaults? No. Is it because they are following some outdated monetary tradition from a bygone era? No. Is it because they have run out of other productive investments? Absolutely not. These are the most sophisticated financial institutions on the planet. They have entire departments dedicated to optimizing reserve allocation. They are buying because they saw what happened to Russia. Connect the dots. Look at the timeline. The correlation is 1.0. In February 2022, the United States and its allies froze approximately $300 billion in Russian central bank reserves. $300 billion. Dollars and euros and pounds that Russia had earned through decades of energy exports. Reserves that were held in the safest financial institutions in the Western world. Reserves that were supposed to be untouchable sovereign assets protected by international law and the norms of the global financial system that had held firm for generations. Gone, locked, inaccessible, seized without a trial, without due process, without so much as a phone call of warning. The reserves of a nuclear-armed sovereign nation confiscated by executive order over a single weekend. But the gold that Russia held physically inside its own borders, inside the vaults of the Bank of Russia in Moscow, could not be touched. Not 1 ounce, not 1 gram, not 1 milligram. It sat there, completely sovereign, completely beyond the reach of Western sanctions and Western political decisions, while $300 billion in paper reserves evaporated like morning fog under a hot sun. And every single central banker in every single capital city on the planet watched that happen in real time and learned the same lesson at the exact same time. If your reserves are held in dollars in Western banks, your wealth exists at the pleasure of Washington. It can be taken from you on a Sunday afternoon with a single decision. If your reserves are in physical gold inside your own borders under your own armed guard, your wealth is truly irreversibly sovereign. That lesson did not need to be taught twice. The buying began immediately, and it has not stopped for a single quarter since. The list of buyers grows every quarter. China, India, Turkey, Poland, Singapore, Czech Republic, Qatar, Hungary, Kazakhstan, Uzbekistan, Serbia. And those are just the ones reporting publicly. The pace is not declining. It is accelerating. Because the geopolitical environment that triggered the buying is not calming down. It is fracturing further. Every new sanction, every new conflict, every new freeze of foreign assets, every new demonstration that the dollar can be weaponized against nations that displease Washington drives another central bank to the same inescapable conclusion. Get out of the paper, get into the metal, before the paper becomes worthless or worse, before it gets confiscated by the very nation that printed it. And here is where the mathematics become genuinely terrifying. Because the volume of gold these nations are demanding is crashing headfirst into a supply wall that nobody on financial television is willing to acknowledge, because acknowledging it would blow up every price model they have ever published. Global gold mine production is approximately 3,600 tons per year. That number has been essentially flat for nearly a decade. It peaked in 2018 and plateaued because the easy deposits have been found and mined. The new discoveries are deeper underground, lower grade ore, more expensive to extract, and located in jurisdictions with escalating political risk and regulatory burden. A major new gold mine takes 15 to 20 years from initial discovery to first pour. You cannot accelerate geology. You cannot legislate new deposits into existence. The supply is constrained by the physics of the planet, and it is not coming back. Now let us look at the demand side, because this is where the picture transforms from concerning to catastrophic. Central banks alone are consuming over 1,000 tons per year. That is 28% of total mine supply going to one category of buyer before a single jewelry maker, a single technology company, a single retail investor gets a single ounce. Jewelry demand absorbs approximately 2,000 tons. Industrial and technology demand takes 300 tons. Investment demand from ETFs, coins, bars, and private holdings takes another 1,200 tons annually. Added it up. Total demand is running at approximately 4,500 tons per year, against 3,600 tons of mine supply. That is a structural deficit of 900 tons every single year. 900 tons of gold that the market demands that simply does not come out of the ground. And nobody is building the mines to close that gap because nobody can build them fast enough. Where does the difference come from? It comes from the buffer, recycling, above ground stockpiles, scrap recovery, Central banks that used to sell gold, leasing it back into the market to earn a return. But those buffer sources are drying up because the sellers have become buyers. The nations that used to lease gold into the market are now hoarding it. The recycling pool is finite and not growing fast enough to compensate. The scrap supply cannot scale because the economics are brutal. The buffer stock is being consumed year after year, drawdown after drawdown. And when the buffer reaches zero, when the inventories run dry, the price does not adjust politely over 12 months in an orderly fashion. It gaps, it teleports. It reprices overnight in a way that makes every mainstream forecast look like a fantasy written by people who never bothered to check whether the metal was actually in the vault. And this brings us to the lie sitting at the very center of the global gold market, the paper gold lie. If you do not understand this mechanism, you will not understand why the repricing event that is building will be unlike anything the current generation of financial analysts is prepared to forecast. You will not understand why the entire establishment is desperate to keep you in paper products. And you will not understand why physical gold in your hand is a fundamentally, categorically different asset from a gold ticker in your brokerage account. This is the part that changes everything. When most people think about investing in gold, they think about buying a gold ETF or a futures contract or an unallocated account at a bullion bank in London or Zurich. That is paper gold. You own a piece of paper, a digital entry, a line on a screen that says a financial institution somewhere promises to deliver gold or its cash equivalent at some future date if you ask for it. You do not hold the gold. You do not have it in your safe or your vault. You are trusting that somewhere in some basement the gold actually exists, and that the institution promising it to you will honor that promise when the moment comes. For decades, that system worked seamlessly because almost nobody ever asked for the actual metal. Everyone was happy with the paper. Everyone trusted the institutions. Nobody demanded delivery. The system ran on confidence alone. Here is the number that should keep you awake at 3 a.m. For every single ounce of physical gold that exists in deliverable form in the vaults that back the global paper gold market, there are an estimated 50 to over 100 paper claims on that same ounce. 100 entities have been told that the same ounce belongs to them. The exact ratio is deliberately kept opaque because full transparency would destroy the system in an afternoon. But the general magnitude is not in serious dispute among anyone who has studied the LBMA clearing data, the Comex warehouse reports, and the OTC derivatives exposure. The paper gold market is leveraged 50 to 100 times against the physical metal that supposedly supports it. Think about what that means. Think about the mathematics of what happens when the confidence cracks. Let us run the arithmetic, because the arithmetic is where beautiful narratives go to die. If the LBMA vaults hold roughly 3,000 tons of gold available for delivery and there are 100 paper claims on every ounce, the paper market is promising delivery of 300,000 tons of gold. Total gold ever mined in all of human history across every civilization on every continent is approximately 210,000 tons. They have sold more paper gold than physically exists on the surface of the planet Earth. Now imagine that just 2% of those paper holders decide they want physical delivery. Just 2 out of every 100. That is 6,000 tons of demand against 3,000 tons of available metal. The system does not bend. It does not adjust. It shatters. And central banks demanding 1,000 tons of physical metal per year, pulling it out of the Western vault system permanently, are applying exactly that kind of pressure on exactly that fault line right now. They are the 2%, and they are not stopping. Now, the mainstream financial media, the pundits on Bloomberg and CNBC, who have spent the last 2 decades telling you that gold is a barbarous relic with no yield and no place in a modern portfolio, they have access to the same central bank buying data I just showed you. They have access to the same LBMA vault reports. They have the same paper leverage estimates sitting on their research desks. And their response is to go on television, straighten their ties, smile politely at the camera, and tell you that gold is interesting but not compelling at current levels. That the smart money is in artificial intelligence stocks and investment-grade corporate bonds. That gold does not pay a dividend. They're lying to you. Or perhaps more charitably, they are so deeply embedded in the institutions that advertise on their networks and sponsor their conferences that they have lost the ability to see the catastrophe they are standing in the center of. Let me dismantle their argument because it collapses the moment you apply any pressure to it. When an analyst tells you gold has no yield, what they are actually telling you, whether they realize it or not, is that gold cannot be printed. Correct. That is the entire point. In a world where every yield-bearing asset is denominated in a currency being actively debased by the institution that issues it, the absence of yield is not a weakness. It is the defining feature. A U.S. Treasury bond pays you 4% per year in a currency that has lost 25% of its purchasing power in 4 years. That is not a positive real return. That is a slow-motion wealth transfer from the bondholder to the government. Gold does not participate in that transfer. Gold sits outside the system entirely. And that is exactly why they want you to ignore it. When they call gold a relic, when they tell you it has no place in a modern portfolio, remind them of one immutable historical fact. Every single fiat currency in human history has eventually returned to its intrinsic value, which is zero. The Roman denarius, the continental dollar, the assignat, the Weimar mark, the Zimbabwe dollar, the Venezuelan bolivar, every single one, without exception. Gold survived them all. It did not merely survive, it repriced violently upward as the paper collapsed around it. Because gold is not a product of any human monetary system. It is what monetary systems return to when the promises break. You can lead a horse to water, but you cannot make it trust a currency backed by $36 trillion in debt, and a government that spends more servicing that debt than protecting its borders. Do not let the gaslighting fool you. Do not let anyone tell you that the largest coordinated central bank gold accumulation in 60 years is meaningless noise. Now we need to bring the Federal Reserve directly into this picture because this is where every thread we have been pulling converges into a single inescapable conclusion. The Fed is not navigating a difficult policy environment. The Fed is trapped, structurally, mathematically, inescapably trapped in a doom loop from which there is no exit that does not involve the systematic destruction of the dollar's purchasing power. Once you see the architecture of this trap, you will never look at the gold price the same way again, and you will understand why the central banks are buying with such urgency. On one side of the trap sits inflation, the kind that makes your groceries cost more every single month, the kind that makes your rent increase every single year, the kind that erodes the value of your savings while the number in your bank account stays the same, creating the illusion of stability while the reality is one of constant, invisible theft. Inflation is the mechanism by which governments confiscate the wealth of their citizens without passing a single law. And the Federal Reserve is supposed to be fighting it by keeping interest rates high enough to slow the economy and reduce demand. That is their mandate. That is their single most important job. And they are failing at it because the other jaw of the trap will not let them succeed. On the other side sits the economy and the debt. Commercial real estate is quietly hemorrhaging value as vacancy rates climb, and refinancing comes due at dramatically higher rates. Regional banks are still nursing balance sheet wounds from the 2023 stress events that were supposedly resolved but never actually were. Consumer credit card debt has hit all-time highs. Auto loan delinquencies are rising. And sitting on top of everything like a thermonuclear device with a corroding detonator is $36 trillion in national debt that now requires over $2 trillion per year just in interest payments. The interest payments alone on the national debt now exceed the entire defense budget of the United States of America. The most powerful military apparatus in human history costs less to operate than the interest charges on the nation's credit card. That is not a policy challenge that can be solved with a clever adjustment to the dot plot. That is a mathematical death spiral with no exit. The Fed has a binary choice, and it is the same binary choice they have faced in every crisis since 1987. Choice A: raise rates aggressively to crush inflation and restore monetary discipline, but that makes the interest on $36 trillion explode further. The housing market crashes. Commercial real estate enters systemic failure. Banks holding underwater long-duration bonds go insolvent. The economy plunges into severe recession. The government cannot afford its own debt service and faces a sovereign debt crisis. Choice B: cut rates to stimulate growth and make the debt serviceable. But that reignites inflation, devalues the dollar, accelerates the central bank exit from treasuries into gold, melts the purchasing power of every dollar in your savings account, and confirms to the entire world that the United States will inflate its way out of any problem regardless of the cost to its currency holders. They cannot choose A without crashing the system. They cannot choose B without debasing the currency. Both roads lead to the same destination: dramatically higher gold prices denominated in a dollar that is worth dramatically less. The Fed will choose B. They always choose B. Every central bank in history facing this exact dilemma has chosen B because the slow, invisible theft of inflation is always deemed politically preferable to the immediate visible catastrophe of a deflationary depression. They will sacrifice the currency to save the structure. They will inflate the debt away by destroying the purchasing power of your savings. And gold is the asset that absorbs that sacrifice. It has absorbed it every single time for 5,000 years. That is not an opinion. That is the archaeological, historical, and monetary record of human civilization. And here is the doom loop that seals the trap shut permanently. What happens when you print money to service $36 trillion in debt? The currency devalues. What happens when the currency devalues? Foreign holders of dollars sell them faster. What happens when they sell dollars? They buy gold. What happens when they buy gold? The price rises and signals to the entire world that the dollar is losing credibility. What happens when credibility erodes? More nations dump treasuries and buy gold. Every action feeds the next. Every intervention makes the problem worse. They are trying to put out a fire by smothering it with kerosene, and the kerosene is denominated in United States dollars. They cannot stop printing because the debt defaults. They cannot keep printing because the currency dies. There is no door in this room marked exit. There is only the door marked gold, and the central banks of the world are already walking through it. Do you think Beijing has not mapped this doom loop on a whiteboard in the People's Bank of China? Do you think Moscow has not run every scenario through its strategic planning departments? Do you think the analysts in New Delhi and Ankara and Riyadh are not watching the U.S. debt clock tick past 36 trillion and calculating precisely how many more quarters the system can sustain this trajectory before the math becomes undeniable? They are watching the United States spend more on interest than on its own military. They are watching the Fed signal that it will print whatever is necessary to keep the system liquid. And they are acting on what they see. They are converting every available dollar of reserves into physical gold and pulling it permanently out of the Western financial system. Not because they hate America, because they can do arithmetic. China has been buying through every available channel, through the People's Bank of China officially, through the Shanghai Gold Exchange in massive volumes, through Hong Kong intermediaries and sovereign wealth fund proxies that do not report purchases publicly. The official numbers are staggering, but the true numbers are almost certainly far larger because China has historically underreported its gold holdings by massive margins, revealing the real total only years or decades after the accumulation was completed. India's imports have surged to record levels. Turkey has been accumulating aggressively. Poland purchased over 100 tons in a single year, the largest buy by a European central bank in modern memory. The Gulf states are diversifying away from dollar assets, and the BRICS nations collectively are assembling the institutional architecture for a commodity-influenced monetary alternative, where gold occupies a foundational role. Every ounce that moves from London to Shanghai is an ounce recast into Chinese specification bars, stored in facilities that do not report to the LBMA, and permanently removed from the Western paper market. That metal is gone. This is financial warfare, and the United States is on the losing side of the ledger, not because it lacks dollars. It has infinite dollars. That is precisely the problem. When your primary financial weapon can be manufactured in infinite quantities by pressing a key on a computer, it is not a weapon. It is a vulnerability. And the nations that have figured this out are quietly, systematically, irreversibly exchanging that vulnerability for the one asset on Earth that cannot be counterfeited, cannot be debased, cannot be printed by any committee in any capital, and cannot be seized if it sits inside your own sovereign vault on your own sovereign soil. Gold. Element 79 on the periodic table, forged in the collision of neutron stars billions of years before any central bank was chartered. There is a fixed amount on the crust of this Earth, and we have already mined the deposits that were easy to find. And this is where silver demands its place in this conversation, because anyone who discusses the gold thesis without including silver is giving you an incomplete picture of the monetary regime change that is underway. Silver is not merely a precious metal. It is an industrial metal with deep monetary properties and a dual demand engine that gold does not possess. Every solar panel requires silver. Every electric vehicle contains silver in its electrical contacts and battery management systems. Every 5G antenna, every advanced semiconductor, every cruise missile guidance system, every piece of medical equipment that relies on electrical conductivity uses silver. Industrial demand is hitting records while mine supply is declining. And when gold runs, silver historically runs harder on a percentage basis because the market capitalization is smaller, the above-ground supply is tighter, and those dual demand drivers create a compounding effect that amplifies every move in the broader precious metals complex. The smart money is not choosing between gold and silver. It is accumulating both. So what do you do with this information? How do you position yourself when you now understand that the most powerful financial institutions on the planet are telling you with their actions what they will never say with their words? 3 things. First, understand that the volatility will be extreme, and it is the price of admission to the right side of this trade. Gold does not move in a straight line. Every major bull market in gold has featured vicious pullbacks that shook out weak hands before the next leg higher. The 1970s bull market had a 50% correction in the middle before gold went on to quintuple from the low. If you see the price drop $100 on a random Wednesday and the mainstream media runs breathless headlines about the gold rally being over, do not panic. Smile. Recognize that the central banks did not stop buying during the pullback. The deficit did not close. The debt did not shrink. A dip is not a refutation. It is a gift wrapped in fear. Second, understand the critical difference between paper gold and physical gold, because in the world we are entering, this distinction is not academic. It is existential. If you own a gold ETF, you own a claim on a system that is leveraged 50 to 100 times against the physical metal that supposedly backs it. In a genuine delivery crisis, and we have shown you exactly why that crisis is building, that claim may not be honored at full value or honored at all. Physical metal in your direct possession has zero counterparty risk. It does not depend on a bank remaining solvent. It does not depend on a broker remaining honest. It does not depend on a clearinghouse remaining functional during a systemic crisis. It is the only financial asset on Earth that is simultaneously nobody else's liability. In the monetary regime change that is already underway, that property is the difference between wealth preserved and wealth vaporized. Third, recognize exactly where you stand in the timeline and understand what that position is worth. The central banks have been accumulating for 3 years. The macro hedge funds are building positions now. The sovereign wealth funds are rotating out of treasuries and into hard assets. The evidence is overwhelming, documented in official filings, and publicly available to anyone willing to look. And yet the vast majority of retail investors in the Western world have zero allocation to physical gold or silver. Zero. When they arrive, and they will arrive, because the retail public always arrives after the institutional money has finished building its position, the demand surge into a market. This small will produce price moves that look irrational to the uninformed, but were entirely predictable to anyone who understood the supply deficit, the paper leverage ratios, and the central bank buying data. You are watching that data right now. You understand it. That puts you years ahead of the crowd that will only hear about this story when it hits the front page of every newspaper. And by then, the move will already have happened. You have the information. The central banks have cast their vote with the most definitive instrument available to them, their national reserves, over 1,000 tons per year for 3 consecutive years, at a pace not seen since the last time the global monetary system collapsed and was rebuilt from scratch. The paper gold market is a fractional reserve confidence trick leveraged 100 to 1 against a metal that is draining out of the very vaults that are supposed to back it. The Federal Reserve is trapped in a doom loop where every possible action devalues the currency it is mandated to protect. The national debt is a mathematical impossibility that can only be resolved through inflation, which is another word for the systematic destruction of your purchasing power. And the nations of the world, the ones with the biggest reserves and the longest strategic horizons, are quietly, methodically, irreversibly converting their trust from American paper into physical gold held on their own soil under their own control. The mainstream media will not connect these dots for you. They will not explain the paper leverage. They will not tell you about the vault drawdowns or put the central bank buying data in its proper historical context, because doing so honestly would require them to admit that the system they are paid to defend is disintegrating from within. That admission is not in their job description. Their job is to keep you calm, keep you invested in paper assets, and keep you holding the dollar while the institutions accumulate the metal. This channel exists to do the opposite. The market cipher exists to decode the signals the powerful send through their actions so that you can read them in time to act. You have the data, you have the understanding, you have the conviction that comes not from hype or emotion or a thumbnail with red arrows, but from watching the most powerful financial institutions on Earth bet their national reserves on a single conclusion. Gold, physical gold, in your hands, under your direct control. Beyond the reach of the printing press, beyond the reach of sanctions, beyond the reach of the system that is consuming itself to survive one more quarter, one more election cycle, one more press conference. The game is rigged. It has always been rigged. But for the first time in a generation, the rigging is working in your favor. Because you hold, or you can hold the asset that every central bank on Earth is racing to acquire. And they cannot print more of it. No matter how many committees they convene, no matter how many dollars they conjure, they cannot conjure gold. That is why it wins. It has always won, and it will win again. This is the market cipher. If this video connected dots you had not seen before, send it to one person who still has their entire net worth in paper promises, in dollars, in bonds, in index funds that are denominated in a currency being debased to keep a bankrupt system alive. They need to see these numbers before the repricing makes the headlines. Because by the time it makes the headlines, the vaults will already be drained, the positions will already be built, and the price will already reflect what you learned here today. Subscribe. Hit the notification bell. I will see you in the next one. The old monetary order is ending. The transfer has already begun. Make sure you're standing on the right side of it when the music finally stops.